This is Pete Moore on Halo Talks NYC. I have the pleasure of bringing on a fellow New Yorker hailing from Sag Harbor while we're in New York City, Tom Morrissey. We're going to talk about the health insurance paradigm for self-employed professionals. Obviously, we have a lot of those in our audience right here listening to this. So we're going to make you think differently and understand what your options are. And obviously, insuring yourself is one of the most important things that you can do. For your business, you basically are the key man or key woman in your business, and being available as much as possible is your lifeline. So, Tom, welcome to the show.
Thanks for having me, Pete.
So I know you've dedicated your life to this. We're going to talk about, some of the trials and tribulations of health insurance and how that whole ecosystem works that you guys facilitate. So you want to just give a little background for our audience here on how you got involved here in the first place and why you've dedicated your life to helping other people.
Sure. Well, I started my career, Pete, with Cigna Healthcare back in '85. I spent 25 years with them, just under 25 years. Don't hold that against me. But great training ground. I sold in the middle market in New York. I was responsible for employer coverages from anywhere from 300 eligible lives. My segment was 300 to 5,000 lives, but I did a lot of national accounts work as well. And that's when a broker or consultant was owned an account that was in the national account space, but I had the relationship. So got a lot of exposure there. After spending so much time with them, I had one foot out the door there for a couple of years thinking about doing something different. And the different was we started a Healthy Business Group 14 years ago to really play into the small to middle market firms. I learned at Cigna that these firms were underserved. None of the health improvement solutions, none of the cost saving solutions that the national accounts were getting exposed to were being given those opportunities down market. Created a deal with Cigna. We wrote like 300 plus accounts. That ended up getting morphed into Cigna. So Cigna ended up doing it themselves after a while. So then what we did was we learned quickly that we needed to pivot, and we looked at the solopreneur space. We saw the growth. It depends on who you listen to, but estimates are that there'll be 90 million solo business owners by 2028. I want to say there's about 60 million now. These are the guys, these are the business owners, guys and gals that own these businesses, I think, especially when they're young and healthy, are the ones that get screwed, sorry, pardon the expression, but screwed the most in healthcare. All they really have access to is ACA plans. Most of those, especially here in New York, are, limited networks. They're commercial networks where the businesses that buy them that are larger buy the same health plans, have a full health plan, but, they water them down. They tend to have like 60% of the doctors that they provide to the larger employers. So we decided to go out and especially since a lot of the solopreneurs cannot afford to be locked in HMOs where they can only get care in New York or Ohio or wherever. We wanted to create a health plan specifically for these folks that was based on a PPO instead of an HMO model.
Could you explain to us the difference between a PPO and HMO?
Well, HMO, health maintenance organization, it's more of it's a group model. It's a lock-in model. It's usually confined by the market they're in. So if you think about New York, again, all the ACA plans, except for maybe a couple with Oxford PPO, are all HMOs. They are closed panels. They're generally speaking discounted more. The doctors are discounting their fees and services more than they do in a PPO. And a PPO is wide open. The PPO we operate is all states across the country.
And then what's the rationale for when you were doing your 300 person and over company? Was just, an 80-20 rule, if you will, of go get the bigger deals, and we don't want to really, have to support, opportunities that are a lot of clients, but less revenue per client. Was that kind of the threshold?
That was pretty much it. I mean, Cigna has three major segments. So they did have a down market under 300 life segment, which is the one that when I exited Cigna that I ran it, and we did really well with the small to mid-sized employers, say 50 to 300. But under 50, that gets into ACA. They didn't have a lot of opportunity there.
And are they cutting down the network because they're basically trying to, have the lowest cost suppliers there? So your aggregate exposure on usage is lower, and they're basically taking some of the higher cost potential claims, out of the mix.
You're exactly right. They thin these networks down deliberately because they really only want to keep the docs that are going to allow for lower fee schedules.
Mm.
It's a money saving technique. The carriers are making enormous amounts of money on the exchanges, and that's in part why.
And what you've seen in the health and fitness category, do you delineate between industry groups, or are you basically saying, look, there's 60 million people that are, running their own LLC or S corp,
Mm-hmm.
And any of those people are, part of our market opportunity? Or do you see anything in the health and fitness industry that says, hey, historically the claims or the insurance cost is lower because of what these people do, and maybe they on average take better care of themselves?
Well, sure. I mean, you're looking at preferred risk when you're looking at, just imagine if you put up, let's call it 100 attorneys versus 100 physical trainers. The health quotient of the physical trainers is highly likely to be better than, a comparative group of attorneys, just as an example. By the way, we do business with all of them. We've got quite a few attorneys on our plan, doctors, attorneys, all sorts of professionals, but we do quite a bit of work in the health and wellness space.
And then when you take a look at, you have a relationship with Aetna as of now?
We don't.
Oh, okay. Was that prior?
We had once we sunset Cigna, we worked with Aetna for a bit, but we realized pretty quickly that this is where we want to be. The opportunity is immense. We've got a very unique, I want to say the only organization doing it quite the way we are is ourselves. And, part of the program is that the differentiator of Solo Health Collective is that sometimes it's easier for me to talk about what it's not. So we are not an ACA individual health insurance plan. We're not on the ACA. We're not off market, because there's plenty of carriers that are working off market for the same audience. But we are not that. It's not like you're buying individual health insurance. The key distinction is that with Solo Health Collective, your business, it's a form of business insurance. Your business, you must have an EIN number. If you don't have one, we can help you get one. And it's free, obviously. But the key differentiator is that you need to have an EIN. Your business is joining. You're a business owner without any employees, and you're joining our health plan with you and your family if you have one. And the other distinction is that you go through a short form medical underwriting. It takes about probably 3 to 5 minutes to go through. We'll give you your quote with 5 quick questions: date of birth, gender, home zip code. Do you need spousal coverage or partner coverage? And do you need your children on the plan? Then we're going to give you what our quote would be for 3 different plan designs, only varying by their deductible. Plans are exactly the same, but there's 3 versions. We have a $2,500 deductible, a $5,000 deductible, and then a $10,000 deductible. And then another key part of the program is once you pass the medical underwriting and you get the plan, there is no co-insurance. So your deductible is your maximum out of pocket. So put simply, we've got about, let's say 45% of our population in each of the $2,500 and $5,000 deductibles, then about 10% of the population's in $10,000. But that's your maximum out of pocket. So for the person who buys a $2,500 deductible for their family, as soon as the individual reaches $2,500, the plan pays 100% of covered expenses. And then on a family with a $2,500 deductible, your maximum deductible is $5,000. And that is also your maximum out of pocket. So once you hit that deductible, it's all 100%. And I should mention, all preventive care is covered in full. So we follow the ACA guidelines in preventive care measures that are recommended. So It's exactly the same. We follow the same protocols that for covering preventive care in full, no deductible.
Obviously, a lot of people are taking their health as more of a self-care type of plan. If I look at like your $10,000 deductible, and I kind of view it as like catastrophe insurance, and not necessarily, a lot of people go to the doctor all the time. Like
Right.
I don't go unless there's a serious issue. So when you say preventative care is covered, what is what is preventative care, encompass now? And what are some of the material changes, over time, whether that's fitness classes, massage, acupuncture? Give us a list of what people have
Yeah,
access to.
it's not your acupuncture and all that stuff. It should be, but it's not. And one day in terms of plan design flexibility, we will get there. We're a relatively new health plan. I'll talk about that a little bit later. But for preventive care guidelines, it's really your age and gender appropriate screenings. It's your colonoscopy at a certain age. It's your routine physical exam. We are going to pester you on Solo Health Collective to make sure you're getting all your routine preventive care done so that we can spot anything that might be coming up and take care of it before it happens.
And that doesn't go against your deductible.
Correct.
Gotcha.
Yeah.
And then what are some of the success stories or, savings that you've seen, that you kind of, latch onto and say, hey, this is here's the, cash, differential, not only, and also just the quality of care.
Well, because the member is setting up, it's not a fully insured plan. It's a self-insured business plan, so we can underwrite very specific to age and gender. There's about 1 million rates that for the variances on zip codes, gender, and age. So we have plans that are $2,500 and $5,000 deductibles. We've got a couple plans. Younger males are generally speaking paying less because of the pregnancy age factor. So we've got some males that are spending less than $300, sometimes less than $200 for a $5,000 deductible plan, and that's based on, like you said, the three of us are older, but that young guy that's 26 years old that's not on his parents' plan is, really only going to have routine physical care. And then to your point, it's really sleep insurance. It's for the catastrophic care. So, we never really highly recommend a $10,000 deductible. And that's not just because the person's young and doesn't have any claims, but it doesn't allow the individual to set up a health savings account. So we prefer to have you go to the 2,500 or 5,000 so that this is a long-term decision. It's a long-term buy that you're making, and you can start putting dollars away in a health savings account for when you're no longer 26, 27 and you're 35, 40, and, claims might be coming. You might be an athlete and you might, need you have a knee injury, whatever the case may be. You could have enough money socked away in your HSA to cover your deductible for 2 and 3 years once you're 5, 6 years into the plan.
So what's the maximum that you could put into an HSA? And can you talk about how this change in the IRS code, or it seems like there's been a loophole that's been opened where people can use their HSA, FSA, even like Dwayne Reed, I'll see it on like a DoorDash checkout, use your HSA, FSA card, or we work with a company called Higher Dose. You can buy an infrared sauna blanket with that. So has that materially changed usage? Because I understand there's like $150 billion that's kind of like accrued in these plans that are not really being accessed accordingly.
Yeah, you do know the difference between FSA and HSA, right? So FSA really very different than HSA. FSA is use it or lose it. So you got to spend those dollars in the year you're in. We recommend HSAs because we're running high deductible health plans. They're the way to go. But you're right. They have opened up. And there's, given the internet and all the apps that are out there, give you an example. I'm a big SoulCycle aficionado, if you will.
No way, man.
I do a lot of SoulCycle. And
bike right there.
There you go. Do you have the Soul Bike? Okay.
Yeah, I do. I'm not bragging. I'm just
well, hey, you're staying
part of the cult.
You're staying in good health. Yeah, it is a bit of a cult, isn't it? But listen, I found through the app on my phone that I could work with SoulCycle to have my Soul Cycle classes go through my HSA. So when I buy, $800 or $900 worth of classes, I'm paying for those pre-tax.
Yep.
It's pretty wild what's gone on in terms of what's legal to go against an HSA.
Yeah. These companies that are out there, one called TrueMed that we've worked with or spoken to. One's called Dr. B, which I think does the HSA processing for Soul Cycle. And they give these letters of medical necessity. Is there any risk to that program, or is that, pretty much mainstream now?
I think it's mainstream. I mean, I did it. I to be honest, I was kind of surprised. And you're right about the organization that does do it. But I think they're legit. Could it be looked at as like, a loophole and maybe they stop allowing it? But I don't think you're at any risk doing it in the year you're doing it. I think if anything, it would be curtailed by regulation. They'd have to stipulate that type of the classes like that aren't covered. But, in the spirit of keeping people healthy so they don't hit the catastrophic side of healthcare, we're all for it. Let's keep it going. It's wise use of money.
Yeah. So just explain to us, if I become a member of Solo, or if I become a member of, talk about Cigna or Aetna or Humana, is there any risk that I'm taking as a patient or a member, being part of one of those larger brand networks versus being part of a somewhat newer plan? Like, is there any balance sheet risk, or is there anything that would be a differentiator? Or it's really just, hey, look, we provide this plan. The money that you pay in goes into effectively an escrow account, or you've got a back office provider that's bonded in that. Just to explain to us.
Well, the key is that it's all about the reinsurance. So Solo specifically, we have partnered with a captive insurance company called Vault. Vault created this back in 2017, working with the North Carolina Insurance Department's captive division. They got it approved, allowing for solo business owners and their families to take this form of business insurance. And the way it's set up is it's not fully insured. You're setting yourself up with what is deemed a self-insured plan. Don't want to make sure we don't scare anybody off with that, because that's a technicality. It's self-insured. It's called level funding. So your entire rate is known as a level funded rate, where if you're paying, let's say $500 a month for a single at the age 40, 45 maybe, a portion of that, call it 20%, I'm making these numbers up, but would go towards administrative expenses. And the rest of it would go to setting reserves and going to the claim liability. And so the dollars that are meant for claim liability, you as a solo owner or as a solo member are actually a pro rata owner in the captive.
Okay.
So we're required through Vault, and they go through this every year, where it's more than likely in the history of Vault, they have always had a surplus at the end of the year, because they're underwriting it such that the rates that go for the certain ages and genders are created to cover expected claims plus a corridor or a surplus liability, sort of a safety net. And the idea is that every year that would need to be returned to the customer. Now, it's not returned in terms of cash dividends. Some of the larger employers, like back in the day at Cigna, I wrote a lot of level funded business where the surplus was returned in part. Cigna would keep 2/3, the employer would get 1/3 back. This is 100% returned, but it's returned in the way of rate increase mitigation or plan design enhancements. It's not dealt with in cash. But getting back to your original question about risk, the other important piece of this is that under the Vault captive, Odyssey Reinsurance Company out of Stamford, Connecticut, they're A+ rated on Standard & Poor's and AM Best. They have the risk for every dollar over the complete exposure of the captive set at the rates that I just mentioned individually. So if we've never had an aggregate stop loss claim, meaning the entire pool the claims exceeded the entire pool. That's never happened. There's been some specific stop loss claim issues where a large claim, call it a $200,000 or $300,000 claim, that would pierce the individual stop loss level. And then Odyssey Re kicks in and pays everything over, in this case, $150,000 of the claim. So if you have a $250,000 claim, Vault pays 150, Odyssey Re picks up the other 100.
Gotcha. So, harken back to Soul Cycle for a minute. A lot of the instructors there who, I used to follow them around pre-COVID, wherever studio they were at. Mantis was my go-to. He stipulated to me that, look, one of the reasons why I stayed as a Soul Cycle instructor and I signed that exclusivity was because they gave me benefits, and there's nowhere else I could get insurance benefits. So, from a standpoint of a group like Soul Cycle, is that a target for solo? And then could they just add on to their account these instructors, or do they basically promote that we've got a relationship with solo, we'll pay your deductible, and you're basically like a direct member, or how does that work?
I wish that could work, but no, the individual, like all these instructors, more than likely, I know a lot of them are doing sidebar stuff, right? They're trainers, plus they're doing Soul Cycle. So if they're getting benefits through Soul Cycle is more or less going out like an employer would and securing coverage for eligible participants. They're probably funding, some of the rules are you have to fund at least 70% of the cost. Ours is the business owner, that Soul Cycle instructor that maybe they're in their waiting period, or maybe they're just not eligible based on hours. That Soul Cycle instructor could set up a solo plan using their EIN and the business that they're running. XYZ.
Got it. And you did a deal recently with the freelancers union, is that correct?
Yes, that's been tremendous. Freelancers Union, we're really impressed with them. It took a good year. We started solo late 2024, so we missed the January 1 big enrollment push because we really didn't have our stuff together, if you will, until like October, November of 23. So for 1/1/24, we didn't write a ton of business, but we started talking to organizations like Freelancers Union. They've got 600,000 members, all right in our wheelhouse. They're all independents. Rafael Espinal, the director of Freelancers Union, great guy. They do a phenomenal job with their benefits package. They're offering ACA plans. They offer us, and they offer a company called Opolis, all three of which are kind of worth exploring. But as an organization, they've been incredible. And I think it's an endorsement for us because they took a while to end up partnering with us after kicking the tires pretty hard. One of the things that we are up against is brand. We're creating a brand from scratch. So that takes a while. So we're going to be relying on the 500 plus businesses we wrote for January 1 to refer us to their friends and families, business owners. We'll be relying on the Freelancers Union to push us out further based on reputation. So that all helps. But that's been a great partnership so far.
So when you look at our, Halo sector, health, active, lifestyle, outdoors, you take a look at, massage therapists, acupuncturists, personal trainers, all these like wellness coaches that are out there now that are basically, independent operators. What are some of the targets that we should be thinking about, or someone listening to this podcast saying like, this is a vital part of a cooperative or a union or a, collective that we have that we need to provide solo, because this is one of the things that, a lot of our members, that's probably one of their biggest stress points.
Sure. No doubt. Listen, I don't often get a chance to talk about the long-term play of solo. Usually we're talking to business owners in the year they're in. We're talking about the savings we're generating for them on rates and premium and design. Design being important because that PPO, no boundaries across the country, internationally, no lifetime benefit maximum, no annual maximum. I mean, you're talking a full-on plan, but I think the biggest value proposition of what we're doing today is the long-term sustainable approach. It's that we expect, and this was evidenced by what Vault did for January 1, 2025 in terms of renewals. The renewal indexes were far below what the industry averages were, both for larger employer paid stuff and ACA plans. So what you're doing is you're buying in, you're getting in, you're filling out a health questionnaire, you're healthy today, you're passing. You don't have any heart issues, organ issues, You're not on any of these ridiculously expensive drugs. So you're able to self-insure your plan, but then you're joining this collective. And together we're managing a risk of healthier people that over time is going to index at inflation rates that are less than those that aren't in the same boat, the more catastrophic claimants.
Got it. So in closing here, being an entrepreneur, being like, a little over a year in, knowing pretty soundly and cold the fact that this is somewhat of a no-brainer decision. How do you manage your own progress and know that you're playing the long game, and that there's an education process that you're kind of fighting through every day?
It's a great question, and we are learning. So, we're a 8-person organization right now, with the intention certainly to grow as we grow. But we've got a phenomenal team of people. David had mentioned it earlier. Service crew is fantastic, and we did 600 plus consults with 3 or 4 people doing all that work. We all pitched in the December crunch time, but getting the job done. And then what we've got to get really good at, and we haven't even really started yet, is getting to our existing memberships to spread the word and to keep it going. Because any existing solo member that shares that solo with somebody else, first of all, there'll be a referral program. And secondly, they're helping us scale, which again is going to cut cost out of the equation for them.
Great. Well, we'll have all the info on that, Dave. Go ahead.
Pete, real quick, I just have to add, Thomas, for people listening to this, I came across your company on Instagram. Not normally something I would put my own health insurance into. And after speaking to Michael and Christine and doing a good deal of research, it was like, okay, what's the catch? This is too good to be true. What's the catch? And there was none, right? So I signed on as a business owner and EIN, and it's potentially game changer for the trainers, the massage therapists, et cetera, listening to this. And I want to do everything we can to help you get the word out for sure.
Listen, that's very much appreciated. So we'll do it together.
Awesome.
Absolutely.
All right, man. Well, welcome officially to the Halo sector. Thanks for doing what you're doing. And we'll try and bring this on to our entire network in the U.S. and look forward to doing a update check with you guys a year from now.
Fantastic, Pete. Thanks, David.
Thanks, man.
Much appreciated. Bye-bye, guys.
Go Halo.